Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 2nd of June. I'm Daniel Lam, your host for the podcast. Since the war broke out in Iran, we've mainly been focusing upon US equities in our commentaries. So it is refreshing to hear some recent client requests about European equities, and I will share some thoughts that I have in this podcast. In general, European equity markets face uncertainties due to the unresolved geopolitical tensions impacting investor confidence and sector performance. Now, because there's a smaller weighting in AI and tech sectors versus the US, the market positioning in Euro area equities remains neutral. Our house view also sees Euro area equities as a core holding, or effectively neutral. Now, there has been some growing institutional conviction with bullish options activities in the Stoxx 600, indicating gradual rebuilding of directional conviction by institutional investors, with rising call volumes and diminishing put demand, historically linked to modest positive returns. But on the other hand, ETF flows have been mixed. Now, foreign outflows from European ETFs are slowing. That signals reduced macroeconomic fears. But on the other hand, ETF inflows are still strongly favoring the AI-heavy markets, such as US, Korea, and Taiwan, over European cyclicals. Now, in terms of central bank policies, when the conflict first started, money markets priced a more hawkish ECB path than the Fed, reflecting Europe's more immediate exposure to the energy shock. ECB hikes have been well priced in since the middle of March, so therefore European equities held up relatively better through the first half of May, when there was new shock, despite weaker macro momentum. But now, with markets expecting the Fed to hike this year, Europe does not hold this edge of quote-unquote already priced in rate buffer. So therefore, we'll need to see rate hikes being priced out in order to get fresh catalyst for Euro area equities from the central bank space. All in all, the Euro area markets is getting caught between two scenarios: potential sharp rebound in cyclicals if a sharp and genuine de-escalation occurs, versus deeper stagflation-driven declines. Overall, we still believe the AI-driven markets have the edge over Euro area equities at this moment in time. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.